Have we popped the champagne before the fireworks? That's the question of the final story in my two-part overview of forces that will drive the stock market in 2021. Last week, I discussed the strongest tailwinds that could blow stocks into a monster rally next year. Read it here. Today I'll change into my bear alter ego and look at some of what could go wrong. In fact, some Wall Street analysts go as far as to say there's a 100% chance stocks will lose value in the next 12 months. And that has little to do with whether the economy recovers or not. What makes stock prices reflect much more than expectations in business metrics like earnings. Investors' frame of mind, aka market sentiment, such as the desire to take risk and the level of overall optimism, influence them nearly as much. Take the S&P 500 before and after 2008. At the end of 2007, just before the housing collapse, S&P 500 had a forward EPS of 96. In human terms, that means analysts expected S&P 500 stocks to earn on average $96 per share over the next 12 months. Meanwhile, the S&P 500 benchmark hit the decade's record at 1,550, which translates to a forward PE of approximately 16. Then the Great Recession struck. Investors ran for the hills and the S&P took a nosedive in the summer of 2011. Businesses recovered and EPS estimates for the S&P reached 100, surpassing the previous high. That means Wall Street expected the S&P 500 stocks to earn 4% more than they did before the crash. And keep in mind, that's not the actual earnings. That was rather a conservative estimate of resentful and cautious investors in the aftershock of 2008. And yet, the S&P 500 still traded 15% below the previous high forward PE of approximately 12.5. In other words, investors paid 15% less for the same stocks they themselves expected would earn more. Here's what that looks like in a picture. That's the power of market sentiment. Unfortunately, today investors are as far from cautious as they can possibly get. Investors haven't been this greedy since 2000. I have to tell you, it's been hard to find a Wall Street analyst who's saying a bad thing about stocks going into 2021. In fact, some measures show the stock market hasn't seen so much optimism since the dot-com bubble. For example, the reading of the widely cited Citibank Panic Euphoria Model, which factors in a number of metrics from options trading to debt, have reached the highest level since 2000. Tobias Levkovich, the bank's chief U.S. equity strategist, warned investors, current euphoric readings signal a 100% probability of losing money in the coming 12 months if we study historical patterns. Indeed, we saw such levels back in early September as well as right before a sell-off in stocks. Another indicator of optimism is the volume of call options. A call option is a contract that gives you the right to buy a stock in the future at an agreed price. It is an investment product that's often used as a leveraged way to profit from the upside in stocks.